This is Saturday, January 31st, 2026, the day after the bloodbath. The day after silver collapsed from a record high of $122 to $76 in a matter of hours. Over $45 per ounce wiped out. A 35% crash. One of the most violent single-day moves in precious metals history. If you are watching this right now, you are either panicking, confused, or asking yourself one very important question. Is this the buying opportunity of 2026? Or is this just the beginning of something much worse? If you sold yesterday, you locked in the worst loss of the year. If you held through the carnage, you are staring at paper losses that are making your stomach turn. And if you are sitting on the sidelines thinking about buying this dip, you need to watch this entire video before you do anything. Because what I am about to show you does not make sense. The numbers do not add up. And the story the market is telling you is not the real story. Let me give you the facts. On Thursday, January 29th, silver hit an all-time high of $122.67, the highest price in recorded history. By Friday afternoon, silver had crashed to $76. Some exchanges showed prices even lower. Gold fell from $5,595 to below $4,700, the worst day for precious metals in over 13 years. Analysts called it a capitulation event. Traders called it a bloodbath. The headlines screamed, "Silver crashes," in giant red letters. And yet, right now, at this very moment, you cannot buy physical silver. The U.S. Mint has suspended sales of numismatic products. The 2026 American Silver Eagle that was supposed to release in January has been delayed to late February. Subscriptions are already sold out. The Royal Mint in the UK is showing out of stock on silver bullion. The Perth Mint in Australia sent notices to distributors warning of a large backlog of orders and implementing monthly allocations. Costco, the wholesale retailer where you buy groceries in bulk, has implemented purchase limits on silver. You cannot buy as much as you want anymore. Let me say that again so it sinks in. The price just crashed 35%, but you cannot buy the product. In what world does a 35% price crash lead to product shortages? In what world does a collapse make it harder to buy, not easier? In any normal market, when price crashes, supply increases. Sellers come out of the woodwork. Inventory piles up, discounts appear. That is how markets work. But that is not what happened here. Here, the price crashed while supply vanished. The price went down while the whole world ran out. Something is very wrong. And by the end of this video, you will understand exactly what it is. Now, I need you to understand something about what happened yesterday. This was not a normal correction. This was not healthy profit-taking after a big rally. The move was too fast, too violent, too coordinated. Silver dropped 35% in less than 24 hours. That does not happen by accident. That is not retail investors cashing out. That is something else entirely. President Trump announced Friday morning that he intends to nominate Kevin Warsh as the next Federal Reserve Chair. Markets interpreted this as hawkish. The dollar spiked, and then the selling began. But here's what they are not telling you. The selling was concentrated, algorithmic, cascading. When silver broke key technical support levels, trading bots triggered, thousands of contracts dumped simultaneously, forced liquidations hit, margin calls went out, leveraged positions collapsed. The CME had already raised margin requirements earlier in the week. The trap was set. In 30 minutes, silver fell over 20%. In 30 minutes, billions of dollars in value evaporated. But here's the question nobody is asking. If everyone was selling, who was buying? Someone was on the other side of those trades. Someone was scooping up silver at $80, at $76, at prices we may never see again. Someone saw the crash not as a catastrophe, but as a gift. And I'm going to show you exactly who that was. I am also going to show you what the physical silver market is telling us right now. Because while the paper price crashed 35%, something very different was happening in the real world. Something that completely contradicts the headlines. Something that could change how you think about this crash entirely. And finally, I am going to tell you exactly what I think this means for you. Whether you should buy, whether you should hold, whether you should run, but I need you to watch the whole thing. Because if you only see part of this picture, you will make the wrong decision. This is the hidden economy, because the real story is never on the surface. Now, before we go any further, let me give you some context, because what happened yesterday did not come out of nowhere. The warning signs were everywhere, and if you have been following this channel, you saw them too. 2 weeks ago, I told you silver was entering dangerous territory. I showed you that silver was trading more than 100% above its 200-day moving average. I explained that historically that kind of extension is unsustainable. I pointed to the 1980 crash, the 2011 correction. Every time silver gets this stretched, a violent pullback follows. At that time, everyone was bullish. Silver was up 9 consecutive months, the longest winning streak in years. People were calling for $150 or $200. Higher. I told you to be careful. Now here we are. Silver crashed exactly as history suggested it might. But here is what I did not expect. I did not expect that while silver was crashing, the physical market would completely break down. I did not expect mints around the world to suspend sales. I did not expect a complete disconnect between the paper price and physical reality. And that changes everything. That is what we need to talk about. Let me explain something that most people do not understand. And this misunderstanding is costing them money. There are two silver markets. Not one. Two. And these two markets are telling completely different stories right now. The first market is the paper market. This is COMEX in New York. This is where futures contracts trade. This is where banks, hedge funds, and institutions trade billions of dollars worth of silver every single day. But here is what you need to understand. They are not trading real silver. They are trading contracts, promises, digital entries on a screen. Most of these contracts never result in physical delivery. They are settled in cash. The metal never moves. It is a casino where the chips happen to be labeled silver. The paper market is where the price is set. It is where the headlines come from. It is what your screen shows you when you look up the silver price. But it is not reality. It is a reflection of reality, and sometimes a very distorted one. The second market is the physical market. This is where actual silver trades. Real metal. Coins you can hold in your hand, bars you can stack in a vault, the stuff that goes into solar panels, electronics, medical devices, and electric vehicles. The stuff that exists in the real world. Now, these two markets are supposed to be connected. The paper price is supposed to reflect what physical silver is actually worth. When they are connected, they move together. Paper goes up, physical goes up. Paper goes down, physical goes down. The spread between them stays narrow. But right now, at this very moment, they are completely disconnected. The link is broken. The paper market says silver crashed to $76. The physical market says, try finding any at that price. Go ahead. Call your dealer. Check the online shops. See what happens. One of these markets is lying to you. The paper price on your screen, or the dealer telling you there is a 4-week wait and a 40% premium over spot. Which one reflects reality? Let me show you exactly how broken this has become. In a normal market, the premium you pay over spot for physical silver is maybe 5%, maybe 10% for certain products. That is the cost of fabrication, distribution, and dealer margin. Right now, premiums have exploded. Reports from Asia show buyers paying 50% to 60% over the paper spot price. Reports from the Middle East show similar numbers. Even in the United States, premiums on American silver eagles have reached levels never seen before. The paper price says $80. The real-world price to actually acquire physical metal is $100, $120, higher. This is not a small discrepancy. This is a complete breakdown of the pricing mechanism. And here is what makes this truly significant. The crash did not reduce demand, it increased it. Every smart investor in the world just saw a 35% discount on an asset that mints cannot even keep in stock. What do you think they did? They bought. They bought everything they could find. The crash created a tsunami of new demand at the exact moment when supply was already strained to breaking point. So now we have a situation where the paper price crashed 35%, but physical silver became even harder to get. Premiums went up, not down. Wait times increased, not decreased. Product disappeared faster, not slower. That is not how markets are supposed to work. That is not supply and demand in equilibrium. That is a system breaking down in real time. And if you do not understand why this is happening, you will be on the wrong side of what comes next. You will sell your physical metal at the bottom because the paper price scared you. And someone else, someone who understands the game, will happily take it off your hands. Do not be that person. Be the one who understands. Now let me show you what is actually happening in the physical silver market. And pay attention because this is not speculation. This is not theory. This is not some conspiracy from the dark corners of the internet. This is data. This is documentation. This is what is actually happening on the ground, while the paper price tells you a completely different story. Let me start with the United States Mint, the official government mint of the United States of America, the institution responsible for producing American silver eagles, the most popular silver bullion coin in the world. On January 13th, just over 2 weeks ago, the U.S. Mint suspended all sales of numismatic silver products. Their website showed products as temporarily unavailable. When customers called the service line, they were told the Mint was updating prices. But here's what actually happened. Silver prices were moving so fast that the Mint could not keep up. They were selling products at prices that no longer reflected the cost of the metal inside them. They were losing money on every sale. So they stopped. They suspended everything. And when products came back online, prices had jumped dramatically. The 2026 American Silver Eagle Proof coin that was supposed to release in January has been pushed back to February 26th. It will be sold in limited quantities. Subscriptions are already sold out. This is not a minor inconvenience. This is the official government mint of the world's largest economy telling you they cannot meet demand for physical silver. They cannot price it fast enough. They cannot produce it fast enough. They are rationing. Now let me show you what is happening across the Atlantic. The Royal Mint, the official mint of the United Kingdom, one of the oldest minting operations in the world. They have been producing coins for over 1,000 years. Their silver bullion products are showing out of stock. Their website displays notices asking customers to be emailed when products become available. Even basic formats like 1 kilogram silver bars are gone. Now let me take you to Australia. The Perth Mint, one of the most respected mints in the world. They have been producing gold and silver bullion for over a century. Governments trust them. Institutions trust them. Retail investors around the world trust them. In mid-January, before the crash even happened, they sent notices to their wholesale distributors. I want you to understand what these notices said because the language is important. They cited increasing worldwide demand, not decreasing demand, increasing demand. They referenced a large backlog of orders, not excess inventory sitting on shelves, backlog. They announced they were pausing wholesale orders until late February to clear the backlog. They implemented monthly allocations to ensure all regions receive stock. Monthly allocations, that is rationing language. That is what you do when you do not have enough product to go around. This was sent when silver was still trading near 117s before the crash, when everything still looked fine on the surface. If they were already at breaking point at 117, what do you think happened when silver crashed to $76? Demand did not decrease, it exploded. Now let me show you India. One of the largest silver markets in the world. Indians have a deep cultural affinity for silver. They buy it for weddings, for festivals, for savings, for generational wealth transfer. And right now, dealers in India are not just running low on inventory, they are defaulting on deliveries. That means they accepted orders, they took payment, and then they failed to deliver the product. Customers paid for silver and did not receive it. Reports emerged of Amazon India sellers canceling silver orders after payment was already processed. This is not a supply shortage anymore. This is a breakdown of the delivery system itself. When dealers start defaulting, trust collapses. And when trust collapses, everyone rushes to secure physical metal before it disappears entirely. Now let me show you what might be the most alarming data point of all. Costco. Yes, Costco. The wholesale retailer, the place where you buy toilet paper in bulk and rotisserie chickens for $5, they sell silver bullion. And they have implemented purchase limits. You cannot just buy as much as you want anymore. Transaction sizes are being restricted. Think about what that means. Costco built its entire business model on selling things in bulk. That is the whole point. And now they are limiting how much silver you can buy. Why? Because demand is overwhelming their ability to replenish inventory. They are rationing silver the same way they rationed toilet paper during the pandemic. And then there is China. And this is the part that should genuinely concern you. China implemented new export restrictions on silver effective January 1st, 2026. They classified silver as a strategic national security material, the same classification they use for rare earth minerals, the same classification they use for materials critical to weapons systems and artificial intelligence infrastructure. China is now treating silver the way they treat the most strategically important resources on the planet. Meanwhile, data from the Shanghai Futures Exchange shows their silver vaults being drained at an alarming rate. In early to mid-January, before the crash, COMEX registered inventory saw 33.45 million ounces withdrawn for physical delivery in just 7 days. That is roughly 26% of total registered inventory disappearing in a single week. At the Shanghai exchanges, vault levels have fallen to their lowest since 2015. So let me put this together for you. The U.S. Mint is suspending sales and rationing. The Royal Mint is out of stock. The Perth Mint is implementing allocations, Indian dealers are defaulting, Costco is limiting purchases, China is hoarding and restricting exports, exchange vaults are being drained at record pace, and during all of this, the paper price crashed 35%. Does that make sense to you now? Does that sound like a real market, or does that sound like something else entirely? So if physical demand is this strong, if mints are suspending sales, if dealers are defaulting, if exchange vaults are being drained, if the whole world is scrambling to get their hands on physical silver, who exactly is doing the selling? Who crashed the price 35% in a single day? This is perhaps the most important question of this entire video, and the answer reveals everything you need to know about how this market actually works. The selling on Friday was not random. It was not millions of individual investors independently deciding to cash out at the same moment. It was concentrated, it was algorithmic, and it was triggered. Here is what happened. President Trump announced Friday morning that he intended to nominate Kevin Warsh as the next Federal Reserve Chair. Warsh is perceived as hawkish. Markets interpreted this as potentially meaning higher interest rates for longer. The dollar spiked, and then the dominoes started falling. Earlier in the week, the CME Group had already raised margin requirements on silver futures. This was not announced with fanfare, but it was significant. Higher margin requirements mean traders need more cash to maintain the same positions. When prices start moving against them, they get margin calls faster. They are forced to liquidate sooner. The system becomes more fragile, more prone to cascading failures. When the Warsh news hit and the dollar spiked, silver broke below key technical support levels, and that is when the algorithms took over. Trading bots programmed to sell when certain price levels break started dumping contracts. Thousands of contracts hit the market simultaneously. This pushed the price down further, which triggered more algorithms, which triggered margin calls, which forced more liquidations, which pushed the price down even more. In less than 30 minutes, silver fell over 20%. Billions of dollars in leveraged positions were wiped out. Traders described it as a cascading liquidation event, a feedback loop of forced selling that fed on itself until the price had collapsed by a third. But here is what you need to understand. This selling was almost entirely in the paper market. Futures contracts, derivatives, digital entries on screens. This was not people selling physical silver bars. This was not mints dumping inventory. This was institutions and algorithms trading paper promises for silver that may not even exist. And while the paper market was collapsing, something very different was happening in the physical market. The same physical market that was already strained to breaking point. The crash created the appearance of a 35% discount. Every buyer who had been waiting for a pullback suddenly saw their opportunity. Demand for physical metal did not decrease during the crash. It spiked. Dealers reported being overwhelmed with orders. Websites crashed from traffic. Phone lines jammed. The crash that was supposed to scare people away from silver instead triggered a buying frenzy in the physical market. So we have a situation where paper sellers crashed the price while physical buyers rushed in to accumulate. The paper market went one direction, the physical market went the opposite direction. One group was selling something they may not actually have. The other group was buying something they intended to hold. Let me show you another piece of evidence that confirms this disconnect. Lease rates. Lease rates are what it costs to borrow physical silver. In normal markets, when silver is abundant, lease rates are near zero. Maybe 0, 3%, maybe 0, 5%. It costs almost nothing to borrow silver because there is plenty available. In January 2026, silver lease rates exploded. Reports showed rates hitting 8%. Some reports showed temporary spikes, even higher. 8% to borrow silver for 1 month? That is a panic signal. That means physical silver is so scarce that holders are demanding massive premiums just to temporarily lend it out. When lease rates spike like this, it means the physical market is under extreme stress. It means there is not enough real metal to go around. Now let me connect the timing. Nearly all of the heavy selling on Friday occurred during U.S. market hours. When New York woke up and COMEX opened, silver dumped. Aggressive red candles, price collapse. When Asian markets were open, the selling pressure was lighter. Sometimes prices even stabilized or rose slightly during those hours. Then New York would open again, and the selling would resume. This pattern tells you who is selling. American institutions, banks, hedge funds, algorithms running on COMEX. They are the ones dumping paper contracts. Meanwhile, Asian buyers in China, Japan, and India are buying physical metal. Middle Eastern buyers in Dubai and the UAE are buying physical metal. They are taking delivery. They are draining vaults. They are removing silver from the system. The West sells paper. The East buys physical. The paper price crashes. The physical metal disappears. This is not a free market finding equilibrium. This is two different games being played with two different sets of rules. One side is playing with digital chips that can be created with a keystroke. The other side is stacking real metal in real vaults. One side is playing a video game. The other side is taking home the prize. The question you need to ask yourself is simple. Which side do you want to be on? Which market is telling you the truth? The computer screen showing $76 or the empty shelves at every major mint on the planet? Your answer to that question will determine whether this crash destroys you or makes you. Now let me give you the bigger picture, because what happened this week did not start this week. This has been building for years, and if you do not understand the structural forces at play, you will misread this crash entirely. You will see it as the end when it might actually be the beginning. Silver has been in a supply deficit for 5 consecutive years. 5 years. Since 2021, demand has exceeded supply every single year without exception. Let me break that down so you understand the math. Every year, the world mines approximately 820 to 835 million ounces of silver. That is total global mine production. Every mine on the planet combined. That number has been declining. It peaked back in 2016 and has been falling ever since due to declining ore grades, mine closures, and regulatory challenges in major producing countries like Mexico, Peru, and Bolivia. But every year, the world consumes over 1 billion ounces of silver. Industrial demand alone now accounts for over 550 million ounces annually. Solar panels, electric vehicles, semiconductors, medical devices, 5G infrastructure, artificial intelligence data centers. Every technology trend you read about requires silver, and that demand is accelerating, not slowing. Then you add investment demand, coins, bars, ETFs, people around the world buying silver as a store of value, as a hedge against inflation, as protection against currency debasement. That adds hundreds of millions of ounces more. Total demand exceeds total mine supply by approximately 200 to 300 million ounces every single year. In 2024, the deficit was estimated at over 250 million ounces. Some analysts put 2025's deficit even higher. The cumulative deficit over these 5 years now exceeds 800 million ounces. Where does that extra silver come from? It comes from above-ground stockpiles, vaults, reserves, recycling, inventory that was built up over previous decades when silver was cheap and nobody cared about it. Think of it like a bathtub. Mine supply is the water coming in from the faucet. Demand is the water draining out. For 5 years, more water has been draining out than coming in. The bathtub is emptying. Those stockpiles are now running dangerously low. Shanghai exchange inventories are at their lowest levels since 2015. COMEX registered silver has seen dramatic drawdowns. London vaults have experienced significant outflows as metal moves to Asia and the Middle East. The cushion is almost gone. The buffer is nearly depleted. There is no emergency reserve left to tap when demand spikes. This is not a short-term issue that resolves next month. This is a structural problem years in the making, and it is accelerating. Now let me give you historical perspective, because what happened this week has happened before. In 1980, during the Hunt brothers squeeze, silver experienced similar dynamics. Paper and physical disconnected, dealers ran out of inventory, premiums exploded, the paper market said one price while the physical market said something completely different. Silver went from $6 to $50 in months, an 800% move. In 2011, silver ran from $18 to nearly $50 before a violent correction. Again, premiums spiked. Again, physical demand overwhelmed supply at the highs. The patterns rhyme even if the details differ. I am not telling you this crash is definitely the bottom. I am not telling you silver will hit $200 next month. Nobody knows that. Anyone who claims certainty is lying to you. What I am telling you is that the fundamental backdrop has not changed. The deficit is still there. The industrial demand is still growing. The above-ground inventory is still depleting. China is still hoarding. Mints are still struggling. One violent paper crash does not erase 5 years of structural deficit. Now let me tell you what this means for you. If you are holding physical silver right now, do not panic. Do not let the paper price scare you into selling your metal. Look at the facts. Look at the evidence I just showed you. You are holding the one thing the entire world is scrambling to acquire. The paper price is noise. It is manipulation. It is algorithms and leverage and forced liquidations. Your physical metal is worth what someone will actually pay for it in the real world. And right now that is far more than the paper price suggests. If you are holding paper silver, ETFs, futures contracts, certificates, ask yourself one question. If everyone demanded physical delivery tomorrow, could your counterparty actually deliver? The answer is almost certainly no. There is not enough metal. Paper silver is a claim on something that may not exist in sufficient quantity. Understand that risk. If you are looking to buy, understand the reality. The paper price says $80, but finding physical silver at that price is nearly impossible. Premiums are 30%, 40%, 50% over spot depending on the product and region. Delivery times are weeks out. Inventory is thin. If you can find physical silver at reasonable premiums, that inventory will not last. It never does after crashes like this. And here is the paradox that should reshape how you think about this crash. The lower the paper price goes, the faster physical silver disappears. Lower prices create more demand. More demand drains supply faster. The crash made the shortage worse, not better. That is not how a normal market works. That is how a broken market works. Now let me speak directly to you, because there are 3 types of people watching this video right now, and which type you are will determine what you do next. The first type is scared. They watched the crash and they panicked. They see the red on their screen and they feel sick. They want to sell. They want to get out. They want the pain to stop. Fear is driving every thought. Fear is making them reactive. Fear is about to make them do exactly the wrong thing at exactly the wrong time. The second type is confused. They see conflicting signals and they do not know what to believe. The price crashed, but mints are sold out. The headlines scream collapse, but dealers have no inventory. The paper says one thing, the physical market says another. They are paralyzed. They do not know who to trust. They are frozen in place while the world moves around them. The third type understands. They see the paper crash for what it is, a leveraged unwind, an algorithmic cascade, a shakeout designed to transfer wealth from weak hands to strong hands. They see the physical shortage for what it is, a structural crisis years in the making that one paper crash cannot solve. They recognize this moment not as a catastrophe, but as an opportunity. They are using this moment to accumulate while everyone else panics. Which type are you? I cannot make that decision for you. I cannot tell you what to do with your money. That is your choice and your responsibility. But I can tell you what the evidence shows. And the evidence shows a complete disconnect between paper and physical that cannot last forever. Remember what I told you at the very beginning of this video. The price crashed 35%, but you cannot buy the product. Go try right now. Call your dealer. Visit the Mint websites. Check Costco. See what happens. The paper price says silver is cheap. The real world says silver is unavailable. One of those is a lie, and it is not the empty shelves. This is what manipulation looks like in real time. This is what happens when a system built on paper promises collides with physical reality. They can crash the paper price with algorithms and leverage and margin calls, but they cannot create physical silver. They cannot mine it with a keystroke. They cannot fabricate it out of thin air. Paper manipulation can delay the reckoning. It cannot prevent it. The price crashed. The whole world is running out. And now you have to decide which side of that equation you want to be on. You can follow the paper price down, sell your metal at the bottom, lock in your losses, let fear win. Or you can look at what is actually happening in the physical market and ask yourself whether a 35% paper crash changes the fundamental reality of a 5-year supply deficit and accelerating industrial demand. The answer is it does not. The crash changed the price on the screen. It did not change the fact that there is not enough silver to meet global demand. It did not refill the vaults. It did not restock the mints. It did not make China stop hoarding. It did not make solar panels require less silver. The fundamentals have not changed, only the price has changed. And in markets, when price disconnects from fundamentals, one of them eventually has to adjust. Either the fundamentals will deteriorate to match the lower price, or the price will rise to reflect the fundamentals. Look at the evidence, look at the mints, look at the vaults, look at the lease rates, look at the premiums, and then decide which adjustment is more likely. This is the hidden economy, because the real story is never on the surface. It is buried beneath the headlines, hidden behind the algorithms, obscured by the noise. But if you know where to look, the truth is always there. I will see you in the next one.